Hello everybody, Daniel Evans here again, and we're going to spend some time in our last module on corporate strategy looking at M&As and the use of strategic alliances by organizations. We'll dive into the benefits of mergers and acquisitions, understand the difference between mergers and acquisitions, and then we'll also look at strategic alliances as a way to develop the organization's strategy. So let's take a quick look at these different options that are available to us. So we've looked a lot at business strategy and corporate strategy, and we know that there are strategies to diversify, to internationalize, to be innovative, and these can all be achieved through various different means, including, for example, organic development of the organization where it just grows. It can be achieved through a merger and acquisition. And it can also be achieved through strategic alliances. And these are the three different ways that we can go about these different types of growth activities or developmental activities in the organization. Let's take a look at these three different ways to achieve the various strategic goals that we've put into place. Let's first talk about some basics. I want to give you a general idea of what we're going to be looking at. And a general graphical presentation. So, and again, bear with me, these are very simplistic and simple ways to view very complex issues. First off, a merger. A merger basically is when we're taking two organizations and we're combining them into one. Now, the finality is the combination of these two organizations. And in this diagram, it's neither blue nor gray, and it may be more blue or more gray as a function of the power structure in the organization, as a structure of which part of the merger is stronger financially. In any case, the objective is to merge them together. And a pretty good example of this would be Air France-KLM Group, where two airlines came together and merged their activities. So an acquisition is a little bit different. In an acquisition, we've got a situation where we have an organization and typically a smaller organization. And one of these will literally, the larger one typically, will acquire the smaller one. If it could be a reverse acquisition, in the trend would be the other way, but normally it's the large organization that acquires a small organization. And the smaller organization is integrated within the larger organization. Now, sometimes mergers are actually also acquisitions, where one company will acquire legally the other company. A good example of an acquisition is Apple's acquisition of the software Shazam, and that now is a part of Apple Corporation. Another option we've got in front of us is an alliance. And alliances can take two basic forms. One would be maybe a joint venture alliance, where we have two organizations and they combine resources to create a third entity, which you see here. A good example of that would be Hulu, which is a video streaming service that was created by two corporations, the Disney Corporation and NBC Comcast. 2/3 owned by Disney, 1/3 owned by NBC Comcast. And so the original organizations remain, except this new organization is created. And we'll see later on that JVs are often sometimes a way of entry into a marketplace. But we also, and what's important here is there's a share of capital, right? Both of these companies own part of this third entity. But we can have an alliance without capital, or non-equity alliance. And this is when two organizations combine forces, collaborate, and create some sort of, typically an offer, usually market side offer, that provides value, unique value for customers. Two examples that I can come up with very quickly here would be the Star Alliance, which is an alliance of airline companies that offer its customers code share benefits, business lounges, things like that, so you can accumulate miles across the different airlines. So there's they're creating a new offer by working together, or the alliance between, for example, Starbucks and Barnes and Nobles. Barnes and Nobles is a large book chain in the United States, and this alliance allows them to serve Starbucks coffee inside of the book selling stores. So let's move on. So the first choice that we had in our listing was, well, we can just grow by ourselves. So organic development is the default method for pursuing a strategy. It's basically doing it yourself. This is where a strategy is pursued by building on and developing an organization's own capabilities. There are 5 principal advantages to doing organic development. The first would be knowledge and learning. By using the organization's existing capabilities to pursue a new strategy, it can enhance its learning and its knowledge in the organization, and this is a true benefit. Secondly, the advantage of this would be that it can spread its investment over time. Acquisitions typically require an immediate upfront payment, for example, for the target company, whereas organic development allows spreading of this investment over a large period of time. It also makes it easier to reverse out and adjust if things don't go well, which is the exact opposite of an acquisition. It's hard to get out if things don't go very well. The third advantage of organic development, would be that there's no availability constraints. Organic development has the advantage of not being dependent on availability of an acquisition target. I mean, if you want to acquire a company, if you want to grow through acquisition, you have to find the partner. And here we're not dependent upon that. We have no availability constraint. Fourth, question of strategic independence. An organization does not need to make the same compromises as it might be necessary if it made an alliance or with a partner organization. We are very independent. We do what we want. We don't have to give in or give up something with organic growth. And the fifth principal advantage is cultural management. Organic development allows new activities to be created in the existing cultural environment, and there's no risk of cultural clash when we're doing organic development. However, often organizations have to go beyond their own internal capabilities and look externally for methods to pursue their strategies. And so now we'll look at some of those ways to do it, and in particular we'll take a first look at mergers and acquisitions. So M&A are probably a quick way to achieve some big strategic objective. However, they can lead to big failures as well. Many mergers and acquisitions have failed over time. Very few or small, less than a majority will survive in mergers and acquisitions. And we'll see that a little bit later on. The first of this is an acquisition, and we already mentioned this is basically achieved by purchasing a majority of shares in the target company. Now, most acquisitions are friendly. So in the case of Apple and Shazam, this was a friendly purchase of Shazam, but sometimes acquisitions can be hostile or a hostile takeover, where the target management is refusing the offer of the acquiring company. In this case, the acquiring company will appeal directly to the shareholders and try to buy the shares from the different shareholders. A good example of this would be Kraft Foods that made a hostile takeover bid for Cadbury chocolates in the UK. And this was an extremely hostile takeover. Other hostile takeovers exist, and sometimes governments will get involved and stop the hostile takeover from occurring. In general, as I mentioned, the acquiring company is typically larger than the company being acquired. That's what we often see in acquisitions. Now, a merger, as I mentioned in the diagram originally, is the combination of two previously separate organizations in order to form one new company. And And mergers have their own cycle, and we'll see that the merging is popular and is not popular at certain times. And this is something you have to be very, very aware of. Unlike acquisitions, merger partners are often of similar size, with expectations of broadly equal status as well post-merger. So we expect things to be about where they are, which is not like an acquisition when we know that the larger firm will dominate the situation. And as I mentioned before, M&As go through cycles. These are basically linked to changes in the economy, and they can be influenced by regulations and laws and availability of targets and availability of finance and a lot of things. One thing you need to be careful of as a manager is not to get too involved in the merger and acquisition hype. We can see that there's growing phases for M&A activity, and during these high cycles, what can happen is that targets can be overbid. We can start saying, oh, I got to buy a company. This is real popular. I've got to do it. Somebody else is going to grab it, so I've got to buy it now. And so prices are sometimes bid up. So be very, very aware of that as a manager if you're ever involved with an M&A activity, that you may be caught up in this hype period where, in fact, in many cases, companies are overpriced in terms of acquisition activities. So why merge? Let's take a look at some of the strategic motives to undertake a merge with another company. And the first of these motives is strategic, to essentially improve our competitive advantage. First, we can extend our reach. Basically, the M&A can be used to extend the reach of the new firm in terms of geography, products, or markets. This is a pretty basic way to get into new markets and to develop and offer new products. Secondly, it can be used to consolidate. An M&A can be used to consolidate competitors in an industry, where we bring together competitors to achieve benefits collaboratively. What this does is it increases power in the market. It can also increase power over not only rivals but suppliers and distributors. It can increase efficiency, and it allows us to have greater scale of operations to, as I mentioned, to essentially have scale economies, but also to negotiate inputs or with distributors. And the last strategic element would be our capabilities. High-tech companies such as Cisco and Microsoft look at acquisitions of entrepreneurial technology companies as part of their R&D efforts. We spoke about innovation in previous chapters, and we saw that we can actually acquire knowledge, and we can actually acquire competence through an M&A activity. And so this allows us to develop new capabilities. The second block of strategic motives for undertaking M&A activities are the issues of finance and optimal use of financial resources. Financial efficiency is one. An acquirer with a strong balance sheet, for example, if somebody's got a lot of cash, can actually improve the indebted target company's financial performance because they have a weak balance sheet. That's one potential benefit financially. Secondly, in terms of tax efficiency, sometimes there are tax advantages to bring together two companies in terms of the tax laws from different countries, tax regimes, and you may be able to transfer activities from one to the other to take advantage of tax rules. And lastly, asset stripping or unbundling. Some companies are very good at spotting other companies' underlying assets that it may be worth more than the price of the company that's being paid as a whole. And so what we'll do is we'll go in, we'll purchase a company, and then we'll unbundle it and sell off the different assets for a higher price than what we paid for the entire organization. And lastly, there are some managerial motives and incentives for doing M&A activities. The managerial incentives can be very personal and self-interest driven by the manager. One may be of personal ambition. There may be financial incentives involved. The person managing the M&A could have a lot of media attention, can improve their personal reputation. So there's a lot of individual benefits of managing and being a manager of a company during an M&A activity. And also there are bandwagon effects where we feel pressure from shareholders, we feel pressure from the organization to undertake a merger or acquisition. We feel that everybody else is doing it, why not me? And if I don't do it like everybody else, then I'll be seen as a bad manager or a bad business owner. Overall, there are many good and many bad reasons to undertake a merger or acquisition. The general consensus remains that the average performance of deals is unimpressive, and basically about half will fail. But overall, make sure you undertake an M&A for the right reason. So let's take a look at the M&A process. The M&A process basically is broken down to 3 key steps: choosing your target, negotiating the deal, and then integrating. And obviously these first 2 stages include what we often refer to as due diligence, when we're investigating the value of the company, or we're making sure everything's good, that they're not cheating on the numbers, etc. After we've gone through negotiations, the ownership changes hands, and then we manage the post-merger integration phase. And what's very interesting is that it's this integration stage that typically is where things go wrong, because we didn't probably identify potential reasons for post-merger integration failure, like, for example, organizational culture. So let's take a look at this M&A process a little bit more in detail. So when choosing a target, there are 2 main criteria to consider. The first is called strategic fit, and strategic fit looks at to what extent the target that we've identified offers us the opportunity to achieve the strategy, why we undertook an M&A. So this is typically presented as, for example, synergistic strategies or synergistic benefits. We're going to say, oh, we're going to acquire this company. It's providing us with certain benefits. And we got to make sure that they're there. Okay. The challenge is that we often overestimate positive synergies. As we've mentioned in other videos, positive synergies are very, very difficult to manage. They're difficult to create and difficult to manage. And we tend to underestimate sources of negative synergies. If we're merging with a company or acquiring a company, we may have to modify our business model. And that's a big change. And we may have cultural issues to be modified. And if we don't do it well, we'll have negative synergies. So strategic fit is the first element. The second element is organizational fit. And this refers to the match between managerial practices, cultural practices, the staff characteristics between the firms that are merging, or between the various acquisitions. Large cultural, language, or other differences within the organization can create big problems for integration later down the road. And so you really want to understand and measure organizational fit very, 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 very well. And as I've mentioned up here, these 2 elements here, strategic fit and organizational fit, are key components of due diligence, this structured investigation of the target company that happens before we close the deal. Both of these elements, strategic and organizational fit, can be used then as a way to filter out or filter in potential targets for M&A. And again, special attention is often made on organizational fit. So the second stage would be negotiation. So we've gone into our analysis, we've assessed the fit of the organization. Now we can start negotiating. And so bear in mind that negotiation is critical, and it can break a deal down. We can actually find a good partner, and if negotiation doesn't go well, it can destroy a potential deal. Be wary that the price of acquisition is determined through one of many valuation techniques. There are many out there, and sometimes one technique will challenge another. That's obvious. So you want to make sure you're properly assessing the value of the company you're acquiring. And also note that the price is often increased to include a premium for control. This is an additional amount that you have to pay to win control compared to the ordinary valuation of the target. And this can be upwards of 30% of the market value of a company, depending upon the situation in the financial markets. Be careful also of overpaying in negotiations, and then cutting back on critical investments. And this is what's called the winner's curse. If you win in negotiations, you bid up maybe the price, you pay a lot for the acquired company, and then find yourself in a situation where, oh my God, we've spent all this money, now we have to save money. And so you end up decreasing investments in the acquired firm later on, and suddenly you're wondering, well, why did I acquire this firm? We acquired it for the benefits, but we're destroying the benefits by removing investments later on because we overpaid. So be very, very careful of not to fall in this trap of the winner's curse. And lastly, we get to the question of value extraction. And value extraction depends on integration. How do we get value from our merger? So the ability to extract value from an acquisition depends on how it is integrated, obviously. And integration is frequently challenged and is very difficult because, as I've mentioned, because of questions of organizational fit. This is typically where things do go wrong. Poor integration can cause acquisitions to fail. So you've gone through it, you've bought the company, and then you start integrating, and suddenly it all falls apart. And that's not cool, to be blunt. There are two criteria we use when analyzing and undertaking integration. The first being that of strategic interdependence. To what extent is there a need for the transfer or sharing of capabilities? Do we need to share capabilities or not in this acquisition process, for example? There's a presumption that significant transfer or sharing through tight integration can enable the creation of value from the acquisition. And is this the case? Do we need to transfer or share capabilities or not? And the second is a question of organizational autonomy. And sometimes where an acquired firm has a very distinct culture, integration may be problematic, and we may want to maintain a certain high degree of autonomy in the acquired organization, and maybe do that and decrease autonomy slowly over time, allowing us to learn from the other organization's culture.